In the fall of 2001, the world was reeling from a massive terrorist attack and a shaking economy. But inside the boardrooms of Estée Lauder, executives noticed a peculiar anomaly. As consumer confidence plummeted, sales of one specific item shot up by 11%. Lipstick. This phenomenon became known as the lipstick effect. The theory goes that when we feel the ground crumbling beneath our feet, we don't stop spending. We just stop buying houses and furs. We retreat to affordable luxuries, small, tangible hits of dopamine to prove we're still alive. But this isn't a video about cosmetics. It's about the terrifying psychology of scarcity. We tend to think of recessions as lines on a graph. GDP goes down, unemployment goes up, politicians argue, and eventually the line goes back up. We treat it like a bad storm. You board up the windows, wait it out, and then go outside to pick up the branches. That is a lie. A recession doesn't just pause the game. It rewrites the rules. It alters how you date, how you parent, who you trust, and whether you sleep at night. It leaves scars that remain visible on the economy and your psychology decades after the stock market has hit a new all-time high. Here is how the machine actually works and why the next downturn might change who you are. Part 1. Let's start with the money in your pocket. When the economy tanks, the experts tell you that consumer confidence is down. But that phrase is too sterile. What's actually happening is a mass psychological retreat. During the Great Recession, researchers at the University of Chicago found something fascinating. You might assume that when people lose their jobs, they buy less food. They don't. Spending on food for home consumption actually increased. But the way we bought that food shifted violently. We stopped caring about brands. The loyalty companies spent billions building evaporates overnight. During the last major crash, high-income households, people who didn't necessarily lose their jobs, suddenly abandoned their premium grocery stores and flocked to warehouse clubs like Costco. We don't just tighten our belts, we become hoarders. We retreat to the bunker. But the bunker is a dangerous place to be because you're locked in there with your family. This is where the data gets dark. You'd assume that financial stress destroys marriages. Logic dictates that when money runs out, people leave. But the numbers tell a more suffocating story. In the US, divorce rates often decline or stagnate during deep recessions. Why? Because you can't afford to leave. The collapse of the housing market means you can't sell the house to split the assets. The loss of a job means you can't pay for 2 apartments. So couples stay together, but they aren't happy. They become trapped in a pressure cooker. While divorces might stall, the intensity of conflict skyrockets. Research indicates that as unemployment rises and economic strain hits, the risk of domestic violence increases. Men who experience job instability are 3 times more likely to assault their partners than those who are steadily employed. The recession doesn't necessarily break the home. It turns the home into a prison. Part 2. The missing generation. If the people currently alive are trapped, the people who aren't alive are simply canceled. One of the most immediate impacts of a recession is that we stop reproducing. In 2008, as the US economy unraveled, the birth rate didn't just dip, it fell off a cliff. States with the highest foreclosure rates saw the steepest drops in fertility. This makes sense. If you can't buy a house, you don't build a nursery. But here is the mechanism that most people miss. It's not just about this year's budget, it's about the scarring effect on young adults. Imagine you graduate college during a recession. You can't find a job in your field, so you take a job you're overqualified for, maybe waiting tables or working retail. You tell yourself it's temporary, but the data shows that people who enter the workforce during a downturn suffer a wage penalty that can last for decades. They are underemployed, and that status tends to stick. Because their earnings start lower, their trajectory is flattened. They buy homes later, they marry later, they have children later, or not at all. This creates a demographic air pocket, a missing cohort of children who were never born because the S&P 500 had a bad year. Part 3. The Paradox of Thrift. Now let's look at the mechanism that makes escaping this trap so difficult. It's a concept economists call the paradox of thrift. When you see your neighbor lose their job, or you see your 401k turn into a 201k, the rational thing for you to do is stop spending. You save. You pay down debt. During the Great Recession, the U.S. savings rate more than doubled. People did the responsible thing. They tried to build a safety net. But here is the cruelty of the system. What is responsible for you is catastrophic for us. Your spending is my income. My spending is your income. When we all get scared and stop spending at the same time, businesses earn less, so they fire more people, which makes us more scared, so we save even more. It is a feedback loop of fear, and it leads to a shift in how we view the future. We stop trying to optimize for growth and start optimizing for survival. We see this in the stock market data. Even people who kept their jobs became terrified of risk. They pulled money out of the market at the bottom, locking in their losses, and moved to safer assets that yield nothing. This fear doesn't vanish when the recession ends. It lingers. A generation that watches their parents lose their home becomes permanently allergic to debt, potentially missing out on the wealth-building power of leverage later in life. Part 4. The scarring of potential. There's a popular theory in economics called the cleansing effect. It's a Schumpeterian idea that recessions are actually good for us. They're like a forest fire. They burn away the dead wood. Weak, inefficient companies go bankrupt, freeing up resources for the strong, innovative ones to grow. It sounds Darwinian and efficient, but recent modeling suggests this is largely a myth. What actually happens is the scarring effect. When the economy crashes, it doesn't just kill the bad companies. It kills the young companies. It kills the startups that haven't had time to build up cash reserves yet. These young firms are often carrying the most innovative new technologies, the new ideas that would have driven the next 10 years of growth. But because credit dries up and demand vanishes, these potential giants die in the crib. They are potentially good firms that never get the chance to prove they are efficient. This makes the economy older, more stagnant, and less productive for years after the recession ends. We don't just lose money, we lose the future that those companies would have built. Part 5. The trust deficit. Finally, we arrive at the most dangerous dimension of all, the death of trust. Institutions, banks, governments, the media rely on a fragile currency called legitimacy. When a recession hits, especially one caused by systemic greed or oversight, that legitimacy evaporates. Since 1979, trust in major U.S. institutions has declined by 22 percentage points. This isn't just people being cynical, it's a rational reaction to failure. When people lose their homes while watching bankers get bailed out, the social contract frays. This leads to political polarization. The populist critique gains traction. The idea that institutions are just weapons used by elites to protect themselves. This creates a new kind of risk. A society that doesn't trust its institutions cannot solve big problems. If we don't trust the health organizations, we don't handle pandemics well. If we don't trust the Fed, we can't manage inflation. If we don't trust each other, the transaction costs of simply existing go up. So, the next time you see a headline about a looming recession, don't just check your stock portfolio. Look at the grocery store shelves. Look at the young graduate moving back into their childhood bedroom. Look at the couple arguing quietly in a house they can't sell. The numbers on the screen will eventually turn green again. The GDP will recover. But the rules of daily life, the way we trust, the way we build families, and the way we dream about the future might be changed forever. The question isn't when the recession ends. The question is, who will we be when it does?